Welcome to the Deep Dive, where we take a massive stack of complex investment research and really distill it down to the core strategic insights you need.
Hey there.
Today, we are locking on to what institutional equity research is calling, well, maybe the single most compelling, but also most complexly valued growth story in the entire real estate sector.
Yeah, we're talking about the convergence of demographic inevitability and proprietary operational technology.
The silver economy.
Exactly. And for the experienced critical investor, this economy represents an irreversible secular trend. The real challenge, the central investment challenge, is separating the structural market beta, like guaranteed demand tailwind, from the true alpha.
The alpha generated by superior management.
That's it. We are looking for that rare asset that can deliver sustained double-digit compounding growth, but it's packaged in the, usually low-growth wrapper of a real estate investment trust.
And our focus today is Welltower Inc., ticker symbol WELL. The sources we've been digging into assert that the company is executing a strategic maneuver so profound it really warrants a generational shift designation. They're calling it Welltower 3.0.
And this isn't just an incremental improvement.
No.
It's a radical overhaul. It's designed to position the company not as a landlord, but as a data-driven operating platform that's built to completely dominate the high-acuity senior housing sector for the next decade.
It's a fundamental pivot. We're looking at a company that has, consciously rejected that passive, almost bond-like stability of the traditional REIT model.
Right. And by moving towards this operationally intense, data-driven platform, they have fundamentally altered their entire risk and reward profile.
So our mission today is to determine, through some pretty rigorous analysis, if the premium valuation the market is giving Welltower is truly justified by proprietary execution, or if it's just, speculative exuberance driven by that demographic story.
That's the key question.
Okay, so let's unpack this thesis. The entire investment case, according to all this research, it seems to rest on 4 foundational pillars.
4, exactly. And we need to scrutinize each one.
It starts with the inescapable and non-cyclical senior housing supercycle.
That's number 1, the macro story.
Mm.
Then you have number 2, generating demonstrable, repeatable operational alpha.
Right, through their unique data and technology systems.
And then 3 is capital allocation mastery, which is basically leveraging a fortress balance sheet to create accretive growth.
And the last one, number 4, is this radical, really revolutionary total alignment of interest through their governance structure.
So for you, our critical investor, the mission is to scrutinize each of those pillars. Is the demographic thesis deterministic enough to overcome integration risks?
Is that operational alpha quantifiable? Is it a defensible moat, or is it just corporate buzz?
And maybe most importantly, does the balance sheet provide an unfair competitive edge that its peers just don't have?
We have to approach this with skepticism, but also with an open mind, because the recommendation here is a long-term 5 to 10-year outperform rating.
So let's dive right into the macro foundation, because really that dictates the velocity of everything else.
Let's start there. The macro. This is the non-negotiable driver that underpins the whole investment case. Demographics.
It is. The entire thesis hinges not on general population growth, but on this hyper-focused structural shift of one specific cohort.
The 80-plus population.
That's the key distinction. The 80-plus cohort is the exclusive demographic that drives demand for assisted living, for memory care, for high-acuity care. The precise segments that make up the vast majority of Welltower Seniors Housing Operating, or SHO, portfolio.
So we aren't talking about independent living, which can be discretionary.
Not at all. We are talking about needs-based consumption.
And we are standing right at the inflection point of this generational shift.
Absolutely. The first wave of the baby boomers, those born between 46 and 64, they begin to turn 80, starting in 2026.
Just around the corner.
It is. And that moment marks the true acceleration of the demand curve. The demographic forces start moving from, let's say, a steady trend to what the sources are calling a structural tailwind.
What does that acceleration look like mathematically?
This population segment is projected to grow at a compound annual growth rate, a CAG, of 4.8% annually through 2030, and probably well beyond that.
4.8%.
And to put that in context for you, that is a growth rate that is 2 to 3 times faster than the growth of the overall U.S. population.
And it's not cyclical.
Not at all. This is not something the Federal Reserve can suppress or that a recession can derail. It's a deterministic, non-cyclical force. And crucially, because the needs are high acuity, health and safety related, The demand is non-discretionary.
So when a family faces that difficult decision, they can't just put it off.
You can't. Which gives the underlying real estate exceptional defensive characteristics, regardless of what the broader economy is doing.
Okay, so we have this massive non-cyclical demand surge that's building, but what transforms this into a super cycle is the other side of the equation.
The supply side.
Exactly. Why is the supply environment so constrained even when this demand is so visible?
This is where the structural advantage is guaranteed and where we get what the sources amusingly call the underpants gnomes reality.
I love that analogy.
It's perfect.
Yeah.
For the critical investor, this supply dynamic creates the most favorable conditions the sector has seen in over a decade. While demand is surging, the supply of new senior housing units has, well, it's just collapsed dramatically.
How dramatic are we talking?
New construction starts have plummeted by approximately 80% from their peak levels just a few years ago.
80%.
Yeah, this is a supply contraction of historic proportions.
Yeah.
And it's constrained by three concurrent, powerful macro forces, none of which are going to reverse quickly.
Walk us through those, because normally when demand is this clear, capital just floods the sector.
But the capital is frozen. First, you have the high interest rate environment. That's made development financing prohibitively expensive, especially for speculative builds.
Okay.
Second, after the regional bank instability and the broader market tightening, there has been a drastic restriction on bank lending for construction loans in this sector. So that pipeline is just dry.
And the third?
Third, and maybe the most structurally painful, are the elevated construction costs. I mean, both materials and labor. These costs have pushed the economics of new builds past the breaking point for most developers.
And this leads us directly to that South Park analogy from CEO Shank Mitra.
It does. Developers conceptually understand phase one, which is the undeniable demand, and they can see phase three, the eventual profit.
But phase two, the economic feasibility, is completely missing.
That's the perfect summary. Mitra estimates that current market rents would need to essentially double to justify the cost of new construction today.
Double. So if the rent doesn't support the hurdle rate required to cover all those elevated costs, construction, land, financing, nobody breaks ground.
It's a fundamental economic failure point. This isn't a temporary dip, it's a structural barrier.
Which effectively creates a massive multi-year competitive moat for every single existing asset in Welltower's portfolio.
It guarantees it. This isn't guesswork. We have mathematical certainty here. Even if a developer were to miraculously get funding and start today, the typical entitlement, permitting, and construction timeline for one of these communities is 24 to 36 months.
So we can confidently say no significant new supply will hit the market before 2027 or 2028.
At the earliest, which locks in a guaranteed multi-year window of maximum pricing power for existing quality assets.
Well, let's connect that. The demand surge, the supply vacuum, and the financial outcomes. We're already seeing the results, right?
Absolutely. The outcomes are a direct result of this imbalance. I mean, look at the aggregate data. Net absorption, which is the measure of demand, has exceeded inventory growth, the measure of supply, for an astonishing 17 consecutive quarters.
17 quarters. That sustained imbalance is a powerful indicator that occupancy can only go one way.
Up. And we see that translated directly into Welltower's portfolio. Their core seniors housing operating, or SHO portfolio, the engine of Welltower 3.0, it achieved a massive year-over-year increase of 400 basis points in occupancy in Q3 2025.
400 basis points. That velocity of gain is far outpacing their peers.
And that occupancy gain is essential. But for the critical investor, you have to remember, occupancy recovery is market beta. True alpha comes from the second half of the equation.
Pricing power and margin expansion.
That's it.
It's not just how many rooms are full, but how much revenue they generate and at what cost.
Precisely. Welltower reported that same-store revenue per occupied room, or RevPR, grew by 4.8% in Q3 2025. This growth in pricing is critical because, and this is the crucial point, it is outpacing their expense growth, or XPR.
That difference, the spread, is the fuel for margin expansion. Why is that so important right now?
Because for much of the last few years, the whole sector has been in a margin compression environment. Post-COVID, expenses, especially labor costs.
Agency labor spiking.
Exactly, and insurance. They rose much faster than the ability to raise rents. The fact that RevPR is now robustly outpacing XPR, leading to significant margin expansion, it shows they're not just recovering. They're entering a new phase of structural pricing power.
So it's a transition from a recovery story to a pricing power story.
That's the perfect way to put it. The structural conditions are set.
Demand is accelerating, supply is constrained, and they're getting meaningful margin expansion. But here's the critical question. If the macro story is this good, why does Welltower need a 3.0? Why not just sit back and collect rent?
Because just collecting rent is the old triple net model, and that caps your upside. To generate double-digit FFO growth forever, you have to capture that operational upside, and that leads us directly into the strategic pivot.
This brings us to Welltower 3.0, this aggressive shift orchestrated by CEO Shank Mitra. And it really demonstrates a portfolio manager mindset, making a bold, multi-billion-dollar bet on concentrated, operationally intensive growth instead of diversified stability.
It was a conscious decision. Let's swap stable, low-growth assets for higher risk but higher reward operational assets. And the size and the speed of this maneuver were historic for a REIT of this size.
Let's start with the exit. They divested their 18 million square foot outpatient medical portfolio for $7.2 billion. Now, for an investor who values stability, selling a 94% occupied, recession-proof portfolio of medical office buildings, that seems counterintuitive.
It's all about opportunity cost and the cost of capital. Sure, MOBs offer stability and modest, steady growth, typically in the 2 to 3% range.
Right.
But if Welltower genuinely believes they can generate sustainable double-digit NOI growth in senior housing 10% plus, then that stable 2 to 3% growth actually acts as a drag on the overall corporate growth rate.
So for a company positioning itself as a growth stock, holding that slow and steady portfolio became inefficient.
They were optimizing for velocity.
But the financial ingenuity here is how they exited. They retained a preferred equity position and a profits interest in the portfolio they sold.
That's classic high-level financial engineering that only a really well-capitalized entity can pull off. It means they freed up the capital and the management bandwidth required for that operational intensity.
Which is the hardest part of the job.
The hardest part. But they kept a claim on the long-term stable return and the economic upside of the MOB portfolio. They got cash certainty and kept their toe in the water without the operational burden.
And then the entry, a massive $14 billion redeployment, almost entirely focused on high-growth, high-barrier senior housing assets in the U.S. and the U.K.
And the result is the creation of a project pure play. Following this massive rotation, Welltower projects that senior housing NOI will exceed 80% of its pro forma portfolio composition.
80%. So they've transformed themselves into the largest, most liquid pure play vehicle for investors who want direct, unadulterated exposure to that senior housing supercycle.
That's right. And this shift is just inextricably linked to the operating company thesis, the deliberate rejection of the passive landlord model.
For investors less familiar with these structures, we really need to spend some time differentiating the old model from this new RIDEA revolution.
This is fundamental to understanding the change in their risk structure. The traditional REIT model uses triple net, or NNN, leases. They're simple. The tenant, the operator, pays a fixed escalating rent.
And the landlord's upside is capped by that lease escalation, say 2 or 3%.
Exactly. So if the facility doubles its profitability because of the macro tailwind, the REIT doesn't see that benefit. The operator captures all of that alpha.
And RIDEA structures under the REIT Investment Diversification and Empowerment Act, they flip that dynamic entirely.
They do. They allow the REIT to participate fully in the operational cash flows. It's an equity interest in the operations.
So yes, they absorb more operational volatility. They take on the risk of rising expenses, vacancies, labor issues.
They do. But crucially, they capture the full benefit of rising occupancy and rental rate growth.
So in today's inflationary environment where that RevPOR is outpacing ExPOR, RIDEA is a natural inflation hedge because it lets Welltower capture that entire margin expansion, that widening spread.
Exactly. But you raise a critical point. If there's shifting risk, why should the market trust Welltower to be a better operator than its traditional partners? I mean, doesn't that operational intensity negate the whole passive appeal of owning a REIT?
That's the tension, right? Investors traditionally want the safety of a real estate lease, not the volatility of a labor-intensive service business.
And the answer, according to the research, lies in two things: proprietary technology and alignment.
Which brings us to what the sources are calling Alignment 2.0. The RIDEA 6.0 contract. This seems like a radical governance structure that directly addresses the classic agency conflict.
And that conflict is simple. The operator wants to maximize their short-term management fee. The landlord wants the operator to invest in long-term capex that increases the property's value. Their interests aren't aligned.
And the RIDEA 6.0 model solves this with equity.
Yes. With key partners like Koger and Oakmont, The operators have agreed to forego a significant portion of their traditional cash management fees. In exchange, they receive units of ownership in Welltower OP, the operating partnership.
So instead of being incentivized by short-term cash flow from management fees, they're now compensated by the long-term equity currency, the stock price of Welltower.
It's brilliant in its simplicity. It forces operators to focus purely on durable, long-term equity value. That means prioritizing CapEx, focusing on efficient long-term systems, and worrying about the perception of the Welltower stock.
As the sources put it, it creates a utopian idea of everyone swimming or sinking together.
It eliminates that agency conflict by aligning the operator's pocketbook directly with the REIT shareholder's long-term goal.
But to make that operational participation meaningful, they need technology. This leads to the Welltower Business System, WBS, and the Tech Quad. This is their attempt to build a technology moat around a historically archaic, paperwork-heavy industry.
The WBS is an end-to-end operating platform, and the commitment here is profound. They hired Jeff Stott, a veteran CTO from Extra Space Storage.
A sector known for its efficiency and tech integration.
Exactly. They're signaling they are importing best practices and operational intensity from sectors that are light years ahead of traditional healthcare real estate.
And the critical failure point they're using technology to eliminate is latency. We need to quantify the financial impact of this.
Latency is the single greatest killer of customer conversion in this industry. CEO Mitra noted that in many senior housing communities, the lag between a potential customer inquiry, a sales lead, and a meaningful human response can be 2 or more business days.
2 business days. In that time, that family has called 3 other places.
Of course. And think of the cost. A single unit of senior housing at, say, $5,000 a month costs $166 per day when it's vacant. If poor latency adds 2 days of vacancy time per move-in across hundreds of properties, that's a monumental, unnecessary cost.
So WBS is designed to slash that.
Specifically, it's designed to eliminate that lag, to reduce response time from days to single minutes. This is where you generate operational alpha. Faster response times lead to dramatically higher conversion rates, which drives occupancy.
And those occupancy gains feed back into the data system. The Tech Quad uses a decade-old, highly proprietary data science team processing trillions of data points. What specific decisions are being informed by that?
Everything. From high-level site selection understanding where demand is densest and competition weakest to micro-level labor scheduling, the data science can optimize shift times to reduce overtime and reliance on expensive agency labor. It can even predict facility maintenance needs before a mechanical failure occurs.
So it's a self-reinforcing operational loop.
Efficiency drives occupancy, occupancy generates more data, better data refines efficiency. It's a capability that is proprietary and extremely difficult for traditional competitors to replicate.
Let's move from the operational engine to the financial framework. The third pillar is capital allocation mastery. For the critical investor, this section is about 2 things: the balance sheet's defensive strength and how they actively monetize their premium stock valuation for accretive growth.
Let's start with the balance sheet, because in a higher-for-longer interest rate world, balance sheet strength is the ultimate competitive advantage.
And Welltower's is incredible.
It's almost radically low leverage. Their net debt to adjusted EBITDA stands at a formidable 2.36 times.
2.36. That number needs serious context. The industry standard for REITs is generally between 5 and 6 times.
Right. And their closest peers, Ventas and HealthPeak, they're both sitting around 5.3 times. So Welltower is operating with less than half the debt burden of its primary competition.
That contrast is the competitive moat.
It is. When capital markets seize up and debt is expensive and scarce, Welltower stands alone as the liquidity provider of choice. They ended Q3 2025 with an astounding $11.9 billion in available liquidity, including $6.9 billion in cash.
That's a war chest.
It allows them to execute massive, quick-moving transactions like that $14 billion acquisition spree with certainty of execution. When a seller needs to close a deal quickly, without financing contingencies, Welltower's balance sheet allows them to pay cash. That's an invaluable lever against capital-starved builders or leveraged peers.
This low leverage also drastically reduces their interest rate sensitivity. It's the ultimate risk mitigation against rate shocks and refinancing risk.
It is. And you see them actively managing that, like when they proactively locked in that attractive 4.50% rate on senior unsecured notes due 2030 back in August of 2025.
That's shrewd risk management.
Now let's transition to how they leverage the market's perception of their growth.
Hmm.
This is the equity as currency concept, the virtuous cycle that's only available to premium-valued companies.
And Welltower currently trades at a significant premium, over 100% premium to its net asset value, its NAV.
Right.
So why is that premium valuation a strategic weapon rather than just a sign of an expensive stock?
Because it enables immediate, non-dilutive per-share accretion through financial arbitrage. Think about the math. They're issuing equity at a high PFFO multiple, around 35.7 times, via their at-the-market or ATM program.
And they're simultaneously buying large portfolios of high-quality real estate at much lower implied multiples, often 14 to 15 times FFO.
By selling highly valued stock to buy relatively undervalued real estate, the transaction itself expands the per-share earnings instantly without damaging the core shareholder base.
That's the definition of accretive growth.
Exactly. And peers trading near or below NAV, they can't execute this math without highly diluting their existing shareholders, which effectively destroys value. Welltower's premium isn't a liability. It is their most powerful competitive tool to consolidate a fragmented market. It's a self-reinforcing financial moat.
But the critical investor has to ask, if the stock were to fall back toward NAV, say to a 25 times multiple, doesn't this entire growth model, which relies on that accretive issuance, just collapse, potentially creating massive dilution risk?
That's the central tension. The risk is real, but the mitigation is the first two pillars, the demographic floor and the operational alpha. If the market is pricing in 20.7% FFO growth, which they are achieving, then the premium is rational and sustainable.
The moment that FFO growth falters, the premium shrinks, and the arbitrage weapon is neutralized.
So the premium is earned by the execution of the 3.0 strategy. They're issuing equity at a favorable cost of equity, enabling high-return investments that peers who would have to rely on expensive debt or dilutive issuance simply can't afford.
We have to look at the results of their $14 billion spree, specifically that HC1 recapitalization, which is a perfect example of financial creativity.
This deal is a testament to Mitra's willingness to step into complex situations. During the heightened uncertainty of COVID, when capital was fleeing the sector, Welltower extended a strategic loan to HC1, a major UK operator.
Right.
But the key was that the loan wasn't just simple debt. It included warrants and rights that allowed Welltower to eventually acquire the real estate equity once the market stabilized.
So they provided essential liquidity during a crisis, and in return, they guaranteed themselves the upside.
And the outcome was phenomenal. They generated a highly impressive, roughly 14% unlevered internal rate of return, or IRR, on the original loan, and they secured the underlying real estate at a material discount to replacement cost.
It's multi-layered value creation.
They acted as a lender, then converted to an owner, capturing both the yield and the real estate appreciation.
And beyond that, their acquisitions are highly disciplined, focusing on geographic densification.
This is a direct linkage back to that operational alpha pillar. Acquiring trophy assets on the East Coast, high barrier to entry markets like Boston and Westchester County, it allows them to create operational clusters.
So they can share staffing, management resources.
Exactly. Regional executive oversight and implement the WBS more efficiently across a focused region. It's synergy capture baked right into the acquisition criteria, which further validates the premium they spend on these assets.
For the critical investor focused on the long term, this fourth pillar, governance and alignment, may be the ultimate de-risking factor. Execution risk is the biggest threat to any aggressive growth strategy, right?
It is. And management misalignment is the typical cause of execution failure in public companies.
Historically, REITs have often suffered from that agency conflict where executives prioritize short-term FFO figures, which drive their bonuses over long-term, expensive but necessary CapEx.
They chase the quarterly earnings beat. Well, Tower's answer to this is the revolutionary 10-year executive continuity and alignment program. This is a landmark structure that essentially forces the C-suite to act as long-term, illiquid owners of the stock.
Let's detail the radical nature of this, starting with the salary cap.
The commitment is it's unprecedented. Base salaries for the top 5 executives, including CEO Shank Mitra, are capped at a nominal $110,000 per year.
$110,000
for the next decade, from 2026 to 2035. That is a token salary for a multi-billion-dollar enterprise CEO.
So their entire financial livelihood is shifted to illiquid long-term incentive plan, or LTIP units.
That's the entire point. They have explicitly sacrificed current guaranteed cash income for the appreciation of the equity currency over the next decade. By eliminating that current comp pressure, They free up mental and financial capacity to focus purely on the long-term compounding of the share price.
But the LTIP vesting is tied to extremely strict, high hurdles.
Oh yeah. They have to succeed on two fronts simultaneously. First, relative total shareholder return. They have to outperform multiple key benchmarks: the FTSE Nareit Healthcare Index, the MSCI US REIT Index, and the broader S&P 500.
So they can't just ride a rising tide. They have to generate true alpha versus the entire market.
And second, market cap growth, with an incredibly ambitious maximum target of adding $100 billion in market cap over 5 years.
Adding $100 billion in market cap over 5 years, that requires sustained high double-digit growth and continued multiple expansion. That is an aggressive target. It forces management to think like portfolio builders, not simple real estate custodians.
And the commitment is locked in by this massive illiquidity clause. The awards are explicitly non-transferable until 2030 and not fully transferable until 2035. This massive lockup period prevents management from being tempted to manage the stock for short-term gains or from cashing out during a market peak.
They are locked into the successful, durable completion of the Welltower 3.0 vision.
This structure is the ultimate antidote to agency risk. It ensures management's focus is exclusively on durable, long-term per-share compounding. It gives shareholders confidence that the execution of complex strategies like WBS implementation and those $14 billion integrations won't be sacrificed for a quick quarterly earnings report.
And it's reinforced by the quality of the team they've built. Mitra is the architect, but hiring John Burkhart as COO, who brings that operational intensity from the multifamily sector.
From Ethics Property Trust.
Right. It shows they're serious about importing best-in-class operational structures.
The whole tech quad structure and dedicated CTO just further underscore that commitment to embedding technology into the core business model.
The ultimate validation of this aggressive strategy has to lie in the numbers. If Welltower 3.0 is working, we should see industry-leading growth metrics that validate that premium valuation.
And the Q3 2025 data provides incontrovertible evidence of execution. Normalized funds from operations, or FFO, is the key profitability metric for a REIT. It represents the company's operating cash flow.
And what was it?
In Q3 2025, Welltower reported FFO of $1.34 per share. That represents a robust 20.7% increase year over year.
20.7%. That kind of sustained double-digit growth is virtually unheard of in the mature REIT sector.
It confirms its characterization as a compounding growth stock, not a yield vehicle. And management is reinforcing this confidence. They raised their full-year 2025 FFO guidance to a range of $5.24 to $5.30 per share, which implies about 22% growth over 2024.
And the true engine driving that FFO acceleration is the same-store NOI from the core SHO portfolio.
That's the truest test of operational alpha.
Why is that?
Because SSNOI measures the growth from the existing pool of assets. It isolates the impact of operational execution occupancy gains, pricing power, cost control from the effects of acquisitions.
So what was the number?
The seniors housing operating portfolio surged 20.3% in Q3 2025. But what's maybe more important than the magnitude is the consistency. This marks the 12th consecutive quarter of SHO SSNOI growth exceeding 20%.
12th. That durability of performance is unique in the sector and validates the underlying demand-supply thesis.
And crucially, this growth is profitable margin expansion. You mentioned the RevPOR growth of 4.8% is outpacing XEPOR. This confluence led to a 260 basis point expansion in SHO operating margins during the quarter.
And that margin expansion isn't just a passive recovery from the pandemic.
Not at all. It is the result of focused internal initiatives managed by the WBS. A key driver of expense control has been reducing their reliance on costly, inefficient agency labor through specific WBS initiatives focused on improving employee retention.
I saw those details about renovating employee break rooms.
Right, simple actions like that. And in test cases, they reduced caregiver turnover by 41%.
And reducing turnover by 41% directly cuts the most painful variable cost in the sector, the premium you pay for temporary agency staff.
It directly and positively impacts the XPR metric.
Correct.
They are achieving margin expansion by improving the efficiency and consistency of their labor pool, which is a structural improvement that enhances the long-term value of the operating platform.
Okay, now let's do the quantitative analysis that is crucial for our critical investor, the peer comparison. We have to contrast Well's growth and risk profile against its primary competitors, Ventas and Healthpeak.
The comparison is unequivocal. Welltower's 20.7% FFO growth absolutely dwarfs Ventus is 10% as Healthpeak, which is showing flat to low single-digit growth. This quantitatively validates their decision to exit those lower growth assets.
And the operational superiority is evident in the occupancy metrics, too. Welltower got a 400 basis point gain, which significantly outpaces Ventus's 270 basis point gain.
The Welltower 3.0 system is demonstrably driving superior execution. But the most defining metric is the balance sheet risk.
The leverage.
Welltower's 2.36 times net debt/EBITDA is radically conservative when compared to both Ventus and Healthpeak, who are both sitting around 5.3 times.
This confirms that Welltower is not only growing at double the rate of its closest peer, but it's doing so with significantly less financial risk and far greater competitive optionality.
Which brings us to the elephant in the room: valuation justification.
With the stock price near $188, Welltower trades at a 2025 estimated PFFO of roughly 35.7 times. Ventus trades around 23 times. That premium needs rational analytical justification.
And the premium is justified entirely by the growth disparity, as the sources argue. You can't pay a 23 times multiple for a stock growing FFO at 10% and demand the same multiple for a stock growing FFO at 20.7%.
So if we adjust for growth, the narrative changes.
Entirely. We should look at the price to earnings to growth, or PEG ratio.
Okay, walk us through it.
Well, you take Welltower's multiple, about 35.7, and you divide it by its growth rate, which is just over 20%. You get a PEG of about 1.7.
Okay, 1.7.
Now do the same for Ventus. A 23 multiple divided by, 10% growth, it gives you a PEG of 2.3.
So, wait, on a growth-adjusted basis, Welltower is actually cheaper.
Mathematically cheaper than its closest competitor. The market isn't irrationally exuberant. It's simply pricing in the sustained high growth rate enabled by that structural tailwind.
And we have to reiterate the cost of capital weapon argument. The high valuation is a tool for accretion.
Trading at 100% premium to NAV allows them to generate immediate shareholder value through acquisitions that peers trading near or below NAV just can't replicate. The premium is rational because it facilitates the acquisition-driven consolidation that fuels future per-share growth.
So what does the market implicitly believe about Welltower's long-term growth if we look at the reverse discounted cash flow analysis?
Working backward from the current stock price.
To justify the current share price of around $188, the market is implicitly pricing in a requirement for 10 to 12% annual FFO growth for the next decade.
And that is an aggressive hurdle, especially for a REIT.
So the critical investor has to ask, can the demographic supercycle, coupled with the supply vacuum, the fortress balance sheet, and the operational levers of Welltower 3.0, can they sustain that aggressive hurdle?
Given the 20.7% growth they just achieved, and the guaranteed supply vacuum extending through 2027, the research clearly argues yes. It suggests the market is correctly valuing the scarcity of this double-digit growth profile.
Let's shift our focus internationally to the company's massive capital deployment into the UK market, including portfolios like Barchester and that HC1 deal. This expansion is critical, but it introduces new regulatory and funding risks.
They are strategically targeting the UK premium market, which means you have to navigate a deeply bifurcated healthcare funding environment.
Right. The UK care home market is sharply split between low-fee public funding, driven by the local authority, and the high-margin private pay segment.
And the distinction in profitability is stark. It's measured by EBITDARM earnings before interest, taxes, depreciation, amortization, rent, and management fees.
A mouthful.
It is. But local authority funding often struggles to cover the true cost of care, so you get these thin margins, less than 20% EBITDARM.
And Welltower's acquisitions.
They're heavily skewed toward the affluent, high-density private pay residents. These segments are insulated from government austerity risks, and they generate significantly higher margins, often exceeding 30% in EBITDARM.
So it's a deliberate portfolio shielding strategy, insulating them from government funding shortfalls like the pressures caused by increased UK national insurance contributions, which squeeze the rest of the sector.
And furthermore, the UK market has a significant regulatory moat enforced by the Care Quality Commission, or CQC. Stricter CQC regulation and the need for modern purpose-built assets, it favors large, well-capitalized institutional players like Welltower.
Because much of the UK's legacy care stock is obsolete.
It is. It lacks modern infection control and amenities. The capital needed for modernization creates high barriers to entry for smaller operators, allowing Welltower to consolidate strategically.
Despite these advantages, any investor buying into a $23 billion pivot has to address the risks head-on. Let's structure this as a rigorous risk mitigation analysis, starting with integration risk.
Integration risk is the primary operational challenge, absorbing $14 billion of new assets across multiple geographies in a short period. It's a massive logistical undertaking. Operational stumbles are a high probability.
So what's the mitigation strategy for such a large integration?
It's multi-pronged and calculated. First, they're using regional densification, clustering the new assets under existing, proven regional operating partners, those RIDEA 6.0 partners. This avoids overwhelming any one operator.
Okay.
Second, the WBS platform provides a standardized, tested systems framework for integrating operations and reducing cultural friction quickly. The complexity of the integration is managed by the simplicity and consistency of the platform itself.
Next, the UK funding and regulatory risks, which extend beyond just the private pay insulation.
We have to acknowledge labor risks, specifically exposure to UK labor laws and immigration policies that affect the availability of care staff.
And there are macro headwinds, Liberation Day tariffs, increasing capex costs, and just the general pain from higher for longer interest rates impacting property valuations.
Right. And how does Welltower mitigate these broader macro headwinds that affect all real estate?
The RIDEA structure provides that built-in inflation hedge we discussed. Revenues can rise with local inflation.
And critically, their extremely low leverage, that 2.36 times debt to EBITDA, it reduces their sensitivity to interest rate shocks dramatically. Peers sitting at 5.3 times debt are forced to refinance large debt loads at current high rates, which crushes FFO. Welltower's fortress balance sheet is their ultimate passive macro mitigation tool.
It seems the core thesis relies on the idea that the structural advantages, demographics, supply constraint, low leverage, are so powerful they can absorb and mitigate the operational and execution risks inherent in the RIDEA model.
That is the precise argument. They are betting that the velocity of the demographic tailwind is so strong and their proprietary operational platform is so effective at generating alpha that the risk is worth the reward. The goal is double-digit compounding growth with single-digit risk volatility, thanks to the balance sheet.
That was an intensive deep dive into the Welltower 3.0 transformation. For the critical stock market investor, the story really boils down to a unique trifecta of advantages converging simultaneously, which is a rare sight in mature real estate sectors.
The trifecta is powerful, it's durable, and it's complementary. First, the macro foundation, that unstoppable non-cyclical demographic demand colliding with a historically constrained supply.
Second, the micro advantage, the proprietary WBS operational platform and data engine designed to generate alpha well above the industry average, which is now aligned through RIDEA 6.0.
And third, the financial fortress, the industry-leading balance sheet, and the ability to weaponize their premium cost of capital to execute that accretive acquisition arbitrage.
The key takeaway here, for any critical investor with an eye on long-term compounding, is to abandon the traditional view of Welltower as just a yield-focused REIT. This is a compounding growth machine operating in a sector with a mathematically certain structural tailwind.
And that alone explains the rich valuation. The 5.7 times multiple is not irrational. It reflects the extreme scarcity of high-quality, high-velocity, double-digit growth opportunities in the mature REIT sector. If you accept the FFO growth is durable and the execution is proven, the premium is rational, especially given the significantly lower risk profile from that fortress balance sheet.
Finally, let's leave you with the provocative thought that underpins the long-term confidence in this stock and the entire 3.0 strategy. Think about the management team's radical 10-year compensation lockup. A nominal salary, all in long-term equity, tied to absolute shareholder return hurdles until 2035.
You have to consider, does this extreme degree of long-term alignment, combined with a decade-long demographic tailwind that is already mathematically certain, does that fundamentally de-risk the execution of the Welltower 3.0 strategy?
Does the management team's personal financial commitment effectively guarantee their focus on per-share value compounding, regardless of short-term market noise or economic volatility?
Our analysis suggests that the structural advantages and alignment mechanisms are designed to compound over the coming decade.
So if the market gives you a chance to accumulate shares during volatility, the structural case suggests this is fundamentally a strong buy and a long-term core holding that should reward patience and conviction.